Real quick, before we get into the show, I wanted to share a new service called Getita that Ken and I have been using that has made us over $10,000 in Amazon reimbursements. The service requires no monthly subscription, and Getita collects a small percentage of the money they recover for you. It takes less than 5 minutes to set up and works on all Amazon marketplaces. Go to Getita.com, Getida, and enter promo code FTM400. That's FTM for Firing the Man 400 to get your first $400 in reimbursements commission free. How much money does Amazon owe you?
I think we're probably 2 or 3 years away from seeing the same thing with aggregators ultimately. And I think it's because they tried to save a little bit on the way in, but ultimately ended up with businesses that may not be top tier. You don't want to be buying a business where the economy can take a bit of a pause or a downturn, and suddenly you're buying a business at X and you have to sell it at Y, for example. There's just been a steady increase in growth over time. And I think that is a dynamic of the multiples and the level they're at this particular point of the market.
Welcome everyone to the Firing the Man podcast, a show for anyone who wants to be their own boss. If you sit in a cubicle every day and know you are capable of more, then join us. This show will help you build a business and grow your passive income streams in just a few short hours per day. And now your hosts, serial entrepreneurs David Schomer and Ken Wilson.
Welcome, everyone, to the Firing the Man podcast. On today's episode, we have the privilege to interview Ismael Wrixen. Ismael was on the podcast way back in episode 88, and he is back with us today to cover the State of the Market 2022. If you miss anything or want to review the entire report in depth, you can download the report at firingtheman.com/FE2022. Ismael is the executive chairman of FE International, the market leader in the sale of SaaS, e-commerce, and content businesses. Over the past decade, Wrixen has overseen 1,200 successful acquisitions totaling more than $1 billion in value with a B. Wrixen was also a NACVA 2018 40 Under 40 award winner. Wrixen's previous background was in large cap M&A, investment banking, where he executed several high-profile public deals, namely in the tech sector. Founded in 2010, FE International is known for its extensive network of pre-qualified and international investors. With headquarters in New York and regional offices in Miami, San Francisco, and London, FE is an international company serving clients worldwide. It was named one of the America's finest, fastest growing companies in 2021 and 2020 by the Financial Times, and also is a 2-time U.S. Inc. 5000 company. We're really excited to get to share Ismael's story and knowledge with the listeners today. Welcome to the show, Ismael.
Thank you very much. Appreciate you having me back.
Yeah, absolutely. We were chatting before the show, and it's been a little bit over a year since you were on last. So happy to have you back on. And
I'm impressed at how many of these you've done since then as well. That's quite an achievement.
Yeah. We love it. I love chatting. I could talk all day. And so, sharing, getting to interview smart, successful people like yourself is what I enjoy every day. So
thank you.
For the listeners that didn't listen to the last show, can you share a little bit with everybody your story, a little bit about you?
Yeah, absolutely. So I appreciate the introduction there. So I am the executive chairman of FE International, which basically means I have a fantastic team of people who make my job very, very easy. So, but before that, my experience was really founded in bulge bracket investment banking. So Morgan Stanley, Citigroup, mainly in the technology sector, doing large scale IPOs and rights issues, block trades, those kind of things. As interesting as it sounds, quite frankly. So I left that about 11, 12 years ago now. I then joined Thomas Smale, who is the founder of FE International, and we basically didn't look back since. So ultimately we started as 2 people in a very small co-working space in a very drab, dingy part of rainy London. And I've now managed to migrate out to our, 8 or so years ago, moved to the US, and I now have the privilege of sitting in our Miami office. So that's, I guess, a little bit about me, but the majority of my experience really is founded, in FE and the work that we've done helping people exit over time.
No, that's awesome. Thanks for sharing. And I bet Miami did you guys get hit with any of the weather lately?
It was meant to come to Miami, and then it kind of, swung around and it went up to the kind of west coast of Florida instead. So we did have to prepare in the same way, but fortunately we weren't hit. Obviously it's tragic what's happened, and it's going to be a very long process, I would imagine, in terms of people recovering. But no, Miami was mainly avoided this time round.
Yeah, that's kind of crazy. Well, awesome. So today we got you on the show. There's a 2020 mid-year report for 2022 that FE International publishes. Can you speak a little bit about that? And is that like an annual report, and where can people find that?
So we publish at least 2 reports per year. And I think, the reason that we've done that, we've probably done that for the last, I'd say 2.5, 3 years, is that, as you know, with, the internet and blogs and threads and forums and everything else, there's a lot of very good information out there, but sometimes it can either be a little bit convoluted or, just a lot to go through. So we have tried to distill that down as best we can in the form of market reports. And with my kind of background in investment banking, research notes tends to be a very good way of communicating what's going on as kind of in terms of a state of the union, if you would. But yeah, I think, that was the main purpose behind it. And then we have just a huge amount of data internally. I mean, we're a very data-driven organization in terms of the way we look at deals. I mean, we've valued I think over 25,000 companies at this point in time, and we've sold over 1,200 companies with a very high success rate. So we have a lot of data that isn't available in PitchBook or Crunchbase or those type of places of what's going on with businesses, I would say, in the kind of 1 to 100 million range that often just isn't available elsewhere. So the idea is that we want to kind of put as much of that data out as possible, give people, the information that they need to make informed and educated decisions if you're on the sell side or the buy side, and going to give a real view into what's happening at this level of the market. So yeah, that's now a biannual report that we publish. We do actually do separate ones. So we do one for e-commerce specifically, one for SaaS, and then one for content, as they all have their kind of different nuances and, different things that are relevant to each. But that's something that we spend at least, I would say, to publish a report, it takes us at least, 2 to 3 months of work to kind of go into that. So they are usually very in depth and quite considered once we actually put them out.
Yeah, no, that's awesome. And again, for the listeners, if you're driving, write this down or come back and listen to it later. You can get the download report at firingtheman.com/FE 2022. And like Ismael said, in the report, there's different reports. They break them all down into SaaS, e-commerce, and content, which I think is pretty awesome to kind of divvy those up because, yeah, they're very different markets and very different data. I really like how, the scale, like for me, I'm a numbers guy, data guy. And so if I talk to someone, maybe a smaller outfit where they don't have as many data points, I take it with a grain of salt. Like, okay, well, they might have done 50 deals or 20 deals, but you're talking thousands, and aggregating all of that data, you get a really good trend line of what's happening in the overall market. So I really like that you've taken all of those data points and that you guys have that many to go from. So the data should be very highly accurate because it's very broad. So awesome. So let's dig right in. Now, it's been a couple of crazy years. There's been ups and downs all over the place. So are people still buying businesses?
Yes. I mean, the good news is that they are. I would say that this part of the market is relatively isolated from what you see on a macroeconomic basis. So, I mean, very aware that, interest rates are skyrocketing, as is inflation, and, a lot of nervous people out there. And I guess for a lot of people, I mean, a lot of the conversations that, we've been having or I've had specifically, especially on the sell side, is that exact, are people still buying? Because instinctively, if you were a ultra high net worth individual looking to acquire businesses, you may pause for a second and say, well, maybe I want to see if multiples come down. Maybe I want to see, how deal structuring, looks going forwards. But the reality of it is that ultra high net worth individuals make up a very small percentage of the people that we sell businesses to. And I suspect that's indicative of the rest of the market as well. So, I mean, we mainly deal with strategic private equity, institutional capital, family offices, those kind of acquirers. And for them, I think an important thing to keep in mind is that during the financial crisis of 2008 to more or less 2012, a lot of them were heavily criticized by their LPs and investors and, effectively places they were borrowing money from for not deploying quickly and, just not deploying during that period. And I feel like a lot of them probably missed out on opportunities, and that's something they don't want to repeat this time round. So I think for, well-run, profitable, growing businesses, there is always going to be buyer demand. And it just so happens that there's more, and we do dive into this in the report. There's, close to about $5 trillion of private equity dry capital out there at the moment. So if you just think about that as kind of one buyer category, then you have the strategics who, yes, are getting a little bit nervous in some cases because they're starting to think about, okay, let's look at the big tech firms, for example. Let's look at Meta and Apple and Google starting to identify, potentially who they're going to be letting go and these kind of things. So some strategics are following suit in the sense that, maybe they're taking a bit of a pause, but, the private equity and institutional capital is more than filling that. And, a lot of the strategics, if there is an opportunity where, it just makes sense, it does make sense to them and they realize that, hey, this may not exist in 6 to 12 months and they would prefer to acquire the business and have it go to one of their competitors, they are still doing deals. So yeah, I think that at the moment, in terms of our own pipeline, extremely healthy. I think we have at least 20 deals either in escrow or very close to going in escrow at the moment, which is pretty standard for us in terms of overall volume. So I would say that we're not seeing kind of buyers pull out of deals. We're not seeing, like I said, we track data very heavily. We're not seeing, any major swings in the metrics and KPIs of businesses going to market, amount of initial interest, amount of, management calls taking place, amount of offers that we're then receiving, and then obviously through to close. So I would say that the market is still strong. And if anything, what we tend to see in markets where the macro status is doing slightly worse than it has done previously is there is more money coming out of equities and being put into private equity firms and being put into hedge funds and institutionals that often back strategics as well. So if anything, slightly more money is going into those areas and that is causing a bit of pressure, which is just kind of pressure coming down market. And ultimately that's helping keep the multiples at least stable and in some cases still growing as well.
Okay. No, that's interesting. So it sounds like deal flow, like everything is, the wheel's still moving forward. It's just certain pipelines of money is pausing, but other ones are still available. You had mentioned, what was it, 5 billion and capital.
It's 5 trillion. So 5 trillion so that's global private equity, capital that's available for acquisition. So, and that number, and there's a really good chart in the report actually, but that number has been growing year on year. So, there is a pressure on private equity, on, institutionals to carry on deploying. And, that a lot of strategics get caught up in that as well, because often they are borrowing from the same sources of capital. So yeah, we're still seeing a lot of buy side demand.
Okay. No, that's good. So digging into e-com M&A a little bit more. So a couple questions that I had is, are deals now, it sounds like the deal flow is going now, is it getting more expensive to get capital? But I guess if you're going with family office or somewhere else, then that it really doesn't matter. But are the deals taking longer to close, or is there anybody doing more diligence, or is that about the same?
Yeah, I would say it's pretty consistent. You hit the nail on the head there. It does come down to the source of financing ultimately, because if you're kind of more on the private equity or let's say aggregator or, and I'm sure we'll get into them, but into institutionals, you have pretty much locked up your money much earlier in the year, or you've taken it from LPs or those kind of places. So it doesn't necessarily, affect you so much. Those financing, and I know kind of SBA is quite popular in the e-commerce space, particularly those financing, those kind of, they've always taken a long period of time to get deals done anyway. That's one of the reasons we generally favor, cash deal or kind of buyers that are kind of independently financed, as opposed to SDA, because those deals just invariably take longer. I wouldn't say there's been a huge shift in terms of the appetite from an SBA side. If anything, obviously rates are moving and they have gone up, but they are there to deploy and to help, similarly, they're there to help, American business owners, get a kind of a footing and obviously, lead to hopefully successful acquisition. So, we're not seeing kind of demand dry up. And it's, I guess, people are instinctively, I guess this comes down to bias, but again, high net worth individuals are probably taking a little bit of a pause, but the rest of them not so much. So, back to my earlier point, there's not really anything that's changed in terms of what we're seeing. And I think that this part of the market, if we're kind of looking at multiples for a second, which I think invariably is where people think, the economy's down, so multiples must be down. There are enough, individual components coming in to create enough of a critical mass to kind of at least keep them steady. And like I said, rising in some cases as well. And I think ultimately that's a good thing for everybody. You don't want to be buying a business where the economy can take a bit of a pause or a downturn and suddenly you're buying a business at X and you have to sell it at Y, for example. There's just been a steady increase in growth over time. And I think that is a dynamic of, the multiples and the level they're at this particular point of the market. There's only really room for the longer term to go up. Whereas if you're looking at the public markets where deals trade for, 15, 20, 30 times forward-looking multiples of companies that may or may not be profitable, that is something where there is obviously a lot of headroom to come down. And you can expect that, buyers would be very nervous in those situations because but it's not really a dynamic that affects this part of the market, I would say.
Okay. Now that's interesting. And I definitely want to dig into the aggregators. I saw some news this morning that I want to cover, but I have one more question before we pivot into that. Like we were chatting before the show, and I was in San Diego last week for a Traffic and Conversion Summit. I was chatting with a group in a mastermind, and a lot of saying the evaluations are so rocky the last couple of years. It was kind of an anomaly. And so what I heard was like a lot of people are kind of like trending from like 2018 to 2022 and kind of taking that trend line and almost like removing 2021, 2020 and just kind of seeing where that trend line goes and see if it lines up properly. When your staff is doing like valuations, are you guys doing that, or how are you guys adjusting for the anomaly of the, of COVID?
It is a great question. I think, so not to get too technical and boring, but the way we do valuations is to look at, 4 different models. And some of them are forward-looking, some are backwards-looking, some are right here, right now. So, for example, the DCF model is a bit more forward-looking. We also use historic price regression and revenue regression, which are a little bit more backward-looking. And then we use comp analysis, which is kind of right here, right now. So, and then what you effectively do is you take those 4 models, you'll football field them, and then, you'll remove the extreme highs and lows to find a weighted consensus of what's there. So by taking that and, certainly, using assumptions, especially around the DCF and the comp analysis, there have been situations where you do have to, exclude certain parts of the data set to make it statistically significant. So, on that basis, there have been situations where we've looked and gone, okay, well, e-commerce, I think, is the big one here. SaaS and content businesses weren't affected in the same way, but there were so many. If we kind of roll the clock back to April or so, 2020, when, Amazon wasn't taking deliveries or this, and there were just lots of issues. And then obviously the supply chain issues, started. And some of those were, situational. Some of those were, massive cargo ship got stuck in the Suez Canal. So it was a little bit hard to predict in a lot of cases. But I think that with a lot of those businesses, you do have to say, okay, well, that was an extraordinary event. Yes, that may happen again, but is it going to happen in our lifetime? Is it going to happen in the next 10, 20, 30 years? Probably, well, hopefully not. So there are situations where we marked 2019 versus 2021, for example. So, but again, very specific to business model, very specific to the business as well. And, I was talking to somebody, the other day, for example, and he was telling me he's now getting containers for, I think it was $5,000 versus $26,000 at the peak. So, that's something that you have to kind of historically go back and remove unless, you think that's going to happen again in the near future. So yeah, there have been situations where from a valuation perspective, we look at, well, what's the underlying trend of this business? This business has been around for 10 years, and we can mark, let's say 2012 through to 2022, and there's this little blip in the middle, but otherwise it's a very consistent trend going up. That's, somewhere where we can start to make adjustments. And then it's just a case of, explaining that on the buy side and then ultimately negotiating around it. And in those situations, sometimes you may end up with a bit of structuring to help alleviate any kind of, potential acquirer concerns that exist. But I think that most people have been working extremely hard since the pandemic to diversify themselves in terms of supply chain and ultimately in terms of, types of products as well, because, consumer behavior has changed and the types of things people are buying today versus buying 5 years ago, are very different because we like to think we're getting back to normal, but it's a new normal now. So I think, companies that have shown the ability to pivot well, that have been resilient, that are in more evergreen spaces, yes, there's definitely an argument to say that we can not ignore the blip in the middle, but certainly take a little bit of a longer term view in terms of how that trend may be migrated.
Sorry to interrupt the episode. You may have heard Ken and I talking recently about a new tool that we're using for Amazon refunds. Now, I have used other refund tools like this. However, I can tell you in the first 7 days, they scrubbed the back end of my Amazon account going back 18 months and found $5,000 of refunds. And the nice thing about this is, it's my money. Amazon made a mistake and they are just auditing my account. The other thing I really like about this tool is there is no monthly fee. They only charge a commission if they are successful in getting you your money. Go to getida.com, Getida, and enter promo code FTM for Firing the Man, FTM400. This is an awesome tool. Can't say enough good things about it. Now, back to the episode.
No, that's a good point. And for, if sellers are out there, owners are out there and they're wanting to go to market, I think that what you just kind of said was hopefully it'll make them feel a little bit safer. Okay, hey, my valuation's not going to be dinged too bad. They're going to kind of smooth it out and make it look right, especially if the business has been operating for 4 or 5 years and you can kind of get at that trend line. It's a newer business, might be a little bit harder, but a business that's 4 or 5 years old, you could probably smooth it out. So, a good point. One other point that you brought up too is, and I really like it, is like, if business owners, founders, operators, whatever you are, if, these last few years were really hard, and if you kind of hit it head on, your business should be more valuable. If you've, got better supply chain, and if you've done all these things to kind of pivot and strengthen your business. Are you seeing a lot of businesses that are coming in that have done that over the last 2 years? Or are you seeing a lot of like distressed businesses?
Yes, it's a great question. I mean, I think generally speaking, we've always prided ourselves on the fact that we only take the very best businesses to market anyway. And to give you a data point around that, of all businesses that will ever come to us and can be valued in the sense that they meet certain growth metrics or other metrics that we look for depending on the business model, only 1.8% of those will ever go to market. And that may involve an exit planning process before we get there anyway. But I think in terms of the businesses that we're seeing, I mean, a lot of them have become a lot more resilient over the last, 1 to 2 years. They've diversified, definitely their supply chain. They've diversified where and how they're selling products, I think as well. That's been a big one. We're seeing more people move off. Well, not move off. They are adding to their, Amazon repertoire, for example, by going more on the Shopify kind of big commerce and WooCommerce route, trying to own their audience a little bit more. I think one metric that, has come out to be extremely important in valuations, especially in e-commerce over the last year or so, is repeat order rates. So I think that's something that, people are starting to think of customer acquisition costs and how can they drive that down further over time. And, that does make you a lot more resilient to, swings you're going to see in the market, be those a forced swing as we saw with COVID and the pandemic, or whether that's more of a trend swing, over time as well. So I think, that is something that, those are some elements that we've definitely noticed. And, business owners are more focused than ever on kind of owning that audience. And ultimately, in some cases, that's meant kind of move away from Amazon and Shopify and other pieces. And that's been very well received in the buyer community as well, I think, because a lot of buyers, what we tend to find is a lot of buyers, they'll look, let's say you have an FBA business, for example, a buyer will come in and say, okay, you built a fantastic base here, you have good products, well reviewed, etc. We're going to take that and we want to, take it off platform. We want to kind of create it, so continue creating its own brand, the Shopify and the such. In theory, that sounds fantastic. That sounds great and something that, everybody should be doing. In practice, it's a lot more difficult. So anybody that can actually can demonstrate that they've started making progress in that area are instinctively going to get higher multiples. And I think we sold a business, I think it was definitely earlier in the year. I think it was Q1 or Q2, called Foxy Bay. I think that ended up going to Boosted or someone similar. And they, in that particular context, I mean, I think the split was, pretty even between FBA and non-FBA. And that was a real kind of winning point. And there was a lot of demand around that particular business just because they had built such a strong brand off platform, but they still had those revenues and, still that critical mass that's being achieved through there. So yeah, I mean, ultimately buyers will continue to search for businesses that are very well diversified, and anybody that can show that they've started to make steps in that progress in that direction ultimately will be rewarded by slightly higher multiples over time as well.
That's very interesting. I think at least a lot of people in our network, in the FBA space kind of looking to take our FBA native Amazon brand and go and Shopify or, D2C. Now, without getting into the weeds and specifics, obviously, but what do you think a straight FBA multiple, let's say for 1 million, let's say 500K in EBITDA, what kind of a multiple how high would the multiple go if the brand showed, say, 10, 20%, 30% D2C sales channels on Shopify?
Yeah, I mean, so there's two elements to it. Firstly, it impacts the multiple and it impacts the deal structure because there's less perceived risk if you're running that profitably as well. But yeah, I think that multiple wise, we haven't seen a huge markdown in terms of, what was happening. I think even last time I was on the show, we're still looking at somewhere in that kind of 4 to 6 times range, trailing 12 months, I would say. And then in terms of deal structure, I mean, the more you can kind of move away from, Amazon as a pure brand, the more kind of cash consideration you're going to get up front for a business like that. But ultimately, it comes down to each business and, the usual caveats of forward looking, projections and all those bits as well. But if you looked at two businesses side by side and one of them had 30% D2C and one of them was 100% Amazon. So in one context, one of them had figured out the D2C supply chain, had figured out how to make a solid return on ad spend through that particular, channel as well. And you own more of the customer data. You are nearly always going to trade at a similar business, just purely FBA. So, but again, that comes with time, that comes with effort, that comes with R&D, that comes with, ad spend, and some of it you may get back, some of it you may not get back. So it's really risk reward. So that's really, what you're looking at there. And businesses that have managed to make, a pivot into that area will attract more buyers. They're much more likely to attract, more private equity and, institutional money as well as just strategic interest, which means that if anything, there's going to be a greater critical mass of people looking to acquire that particular business, which it doesn't mean multiples go out the window, but it starts to mean you are going to get into that more competitive process where the multiple and the ultimate offer in terms are more likely to get pushed up than a business that is just purely FBA.
Gotcha. Yeah. And you hit the nail on the head when you had said that business had figured out how to utilize profitable advertising. And so that is crucial. And it's like R&D. I call it the education fund. You try something and if it doesn't work, well, then it's risk versus reward. If it doesn't work and you go to market, then you're not in a good position. But if it does work, then, you get that reward. So
that's the thing. And if I were a buyer and I was looking at a pure FBA business and one of the growth opportunities was, okay, well, you can take this, we've got a good brand, take it off platform. It's like, well, great. That's easier said than done. And quite frankly, I'm not going to pay you a premium for me having to do that work and me having to put the money in, but I will if you do it. So why don't you go and do that for 12 months, come back and I'll pay you more. That would be the way I would look at it. Because, we see, and I'm not trying to be cynical, but we see, all sorts of businesses, all sorts of growth opportunities and this and that. And it's like, well, on paper, yeah, I'm sure that's a great idea, but the actual execution of it is going to be a lot harder than that. So I think that's why you would end up trading at a premium if you manage to get a, let's say 70-30 balance, as you mentioned there. I think you're always going to trade at a premium to those businesses that are 100% reliant on FBA.
Absolutely. Well, awesome. So let's pivot a little bit into aggregators. Everybody loves to chat aggregators and beat them up and everything else. And so we like aggregators. There's a need for them. And anyway, there's been, say, a tornado of activity in the last, say, 6 months with aggregators. So just this morning, I had read a quick bit on one of the aggregators had some legal issues with, a seller and on an earnout. And it was not good. And so can you speak to a little bit like what's going on in the aggregator space? Are you seeing a lot of that or what's going on there?
Yeah. And I'd be very interested to hear more about that as well. Not shocking, I would probably say, but yeah, But aggregators, I think the first thing to say about aggregators is they are ultimately a very small part of the market. And if you look at I think our report goes into this as well, but I think the report we published two or so months ago now, the current stat is we have about $46 billion of buyer demand across our network. So if you kind of think about, obviously there are lots of, great success stories in aggregators. This aggregator raised 50 million, 100 million, 200 million. Those are very big numbers we're talking about. But when you put it into the greater context of, well, how much money is out there, it's a small percentage. So I think aggregators have had their part in the market and they've actually been very helpful in the sense that when everything was, taking a bit of a downturn, there's a lot of uncertainty with COVID and everything else was being created. They were supporting the market in the sense that they were continuing to acquire and they kept multiples, pretty high in most cases. And now you're starting to see the private equity and institutional capital step back in. And I think that, in a lot of cases, they are becoming, not going to say less relevant, but they're not the only buyer at the table. So I would say, that's the first thing. I have absolutely nothing against aggregators. I think that the mistake that they have made in some cases, and we have seen this happen in the SaaS space, we've seen this happen in the content space, comfortably over the last 10, 12 years. They started out by working with advisors. And the good thing with advisors is we do a lot of the weeding out for them. So I've never seen a business in the e-commerce space try to go to market and had a firm grip on their financials. And you'll speak to somebody and they'll say, and we'll say, listen, we're going to value your business. Here's what we need. We need org chart. We need P&L. We need balance sheet. And then it's always like, well, why do you need the balance sheet? And it's like, well, we need the balance sheet because I can guarantee you're doing cash flow accounting. Even if your accountant tells you otherwise, or even if you hit the little button in QuickBooks that says switch to accrual, you're doing cash flow accounting on some level, and therefore we need to start backing that out, and we need your inventory and multiple time points so we can start to figure out what it actually is. And the challenge is that, aggregators were so intent on buying businesses and quickly to gain market share. And some of them did very well through that. And then you were dealing with people who, through no fault of their own, were presenting numbers that may or may not have been, overly accurate. The deals were just getting done. And, I'm not surprised that there's going to be some fallout around the fact that some of these businesses may be underperforming, or maybe, not kind of where the acquirers thought they were. And I guess, to kind of think back maybe a year and a half, I had a conversation with a particular seller who had unsuccessfully tried to sell their business, and they were talking to me about an offer that they'd received. And the aggregator in that case, instead of actually doing any due diligence on their COGS, they just applied a flat percentage based on other deals that they had seen. So they basically said, we believe your shipping expense is X% of revenue, therefore we're just going to apply that. And it's like, that's beyond lazy. I don't really even know where to start with that. So then fast forward 2 years, if that's the approach you were taking, then I'm not surprised that there are going to be earn-out issues around a bit. So, and, for a lot of sellers in those situations, they were getting approached, they were getting offers that were maybe a little bit higher than the market. They were getting promised, we can close in 30 days, which is almost an impossibility if anybody actually wants to do due diligence on your business. But I think, the mistake that, some of the aggregators made was they were so intent on going direct in these deals because they thought they were going to save money, or they thought they were going to get slightly lower multiples, which in some cases they did. But that's a very short term, look at it. If you start to think, okay, I'm an aggregator, I have debts and obligations, and I have investors, I have LPs, I need to run this business for 5 to 10 years. That one times you're saving on the multiple by going direct to the store owner is nothing compared to, the potential long-term effects of what you're going to have to deal with. So I think that I'm a little bit biased because we run an advisory firm, but I think that where you have advisors, the good thing is that they ultimately weed out and hopefully bring the very best deals to market, and at least do it in a way where the information is organized, it's auditable, there's a clear trail of what has happened. And we saw a very similar thing in a SaaS space, 5 or 6 years ago. And if we start to look back at some of the companies that were, or some of the firms that were aggregating at that particular point in time, I'm not going to go into names specifically, but a lot of them aren't doing very well. So I think that, and there's been, a bit of turmoil with some of those recently, with people leaving, new CEOs having to be brought in to clean up portfolios, etc. I think we're probably 2 or 3 years away from seeing the same thing with aggregators ultimately. And I think it's because they tried to save a little bit on the way in, but ultimately ended up with businesses that may not be top tier but don't get me wrong, some have done very well. So it's a mixed bag out there. And I think that, if you are a seller and you're still getting approached by aggregators, just even go and speak to your M&A attorney or an attorney. If you don't want to hire an advisor, just speak to somebody of a professional ilk that could guide you in the right direction with things like financials and other ilks. So you don't leave yourself exposed to them running it poorly, which if you've gone from 0 to 100 businesses under management in 2 years, nobody can pull that off. They just can't. With the best will in the world and the most skilled people, it's just not something that's realistic. You look at SaaS and Constellation Software and other companies, they've managed to do it over a 20-year period, not over a 2-year period. So I think that, but sellers want to protect themselves as well and make sure if they're agreeing deals that it's actually realistic that they're going to get paid out on all of these elements. And I think aggregators are just so keen to deploy that it was kind of let's kick the can down the road. And ultimately, we've now caught up with the can.
Yeah. Now, it's a good point. And you had mentioned it's kind of like a mixed bag. And so, there's some good aggregators. There's some that scaled too quick. And I'm very old. And so it kind of reminds me of the .com bust. And so if for anybody that's old as me, like you remember that there was a 2 to 4 year period there, the .com, where everything was just insane, crazy. And the last, probably 18 months with aggregators kind of reminded me of that. It was like just feast. And now you're kind of probably seeing the effects of that. And there's likely some distress sales going on in the back room. And you mentioned some leadership changes and stuff like that. And so I think the free markets will kind of shake out over the next 6 to 12 months, and we'll see some aggregators shine and some kind of fade away and go there.
Oh, yeah. And I think to your point there, actually, is a great point. We've actually heard of aggregators selling to other aggregators and selling parts of their portfolio. And I think that's a known secret at this stage. But yeah, that's kind of indicative of where the market is. But the positive thing here is that anybody who is thinking about exiting and kind of, I've been reading that aggregators aren't buying anymore. This company has started laying, and there's been layoffs and other things. The positive news is kind of the key takeaways for me, at least, are they were always a very small percentage of the market in terms of buyer demand. And there's a lot of, capital, private, institutional, and otherwise that's coming back into the space that just couldn't invest over the past couple of years and aggregators. So the way I look at it is the private equity and strategic and institutional capital is the longer term, piece of the pie. They had to step out for a couple of years, which is where aggregators really filled the gap, but they're back and they have a lot more money to spend than aggregators ever had or probably ever will. So I think from that perspective, multiples haven't been moving because of aggregators stepping out of the market. Some deal structuring has changed. I think, what we're seeing specifically with aggregators is on the sell side, aggregators are having to justify themselves more and more to sellers as to why should we accept your offer? What are you actually going to do? If you're going to accept a performance element or a stability element to a deal, you actually need to prove that you have the ability to run this business and it's not going to become one of the 100 and ultimately you're not going to focus on it. And we're going to have a legal conversation for, as you alluding to the news that you read about this morning.
Yeah, absolutely. Awesome. So kind of pivoting a little bit, and I saw something, I think it was probably last week. It was actually a Facebook ad. They were targeting me, and it was a Shopify roll-up or Shopify aggregator. So are you seeing a lot of those?
I think I've seen the same one. Yeah, I've seen I've seen that as well. I can't remember what the actual ad was, but it was one of those, we'll buy your business almost instantly kind of things. They are still there. They're still around. They're still looking to do deals, but I think that the 6 times multiples they were paying blind have started to come down to more kind of, 4 to 6, which is the tip. They're starting to look at businesses in the way they probably should have been looking at it before. It was just a land grab. But I think there are lots of these. I think the one I specifically saw was, we'll help you, value and exit plan in it, and you kind of click through a little bit and you're like, oh, you're actually an aggregator. Got it. Okay. But no, I think I've seen a very similar thing to that.
Yeah. No, I thought it was interesting, and I didn't look too deep into it, but I thought, maybe it's some aggregators like thinking, the Shopify, maybe it's more stable. Maybe we're going to kind of float some money over there and kind of go up from there. But no, that's interesting that you saw the same ad. So, well, awesome. I know we're coming up on time, so maybe you can just grab a couple of key takeaways on the report for everyone.
Yeah, absolutely. So I think the kind of key takeaways that we're seeing is that the market is still very strong. I think that's the thing we try to get across, and not just us saying that, we're actually putting data behind that in terms of how much buyer demand there is out there. I would say that, for people looking to sell or, exit plan, the advice is always, very similar from us. It's kind of keep running the business as if you weren't going to sell it, because our success rate is 94.1%. So it's very high. It's probably artificially high by the fact we only take 1.8%, businesses that get value to market anyway. So we kind of, the ball is kind of in our court in that perspective. But I think that there is still a chance that, you may go through a process, you decide, it's not for you, and ultimately you want to carry on running the business, and you don't want to be tied into kind of short-term decision making, longer term. So I'd say always run the business, with a sensible level head and, as if you weren't going to sell it. I think that, one of the things that, definitely comes out of the report is that buyers are becoming, they always were very niche specific. They're kind of, digging, kind of doubling down on a lot of that. So, if you are, I think businesses, especially if we kind of look at e-commerce that sell too many products, just don't really have a focus. There's a brand in the sense that you have a name, but if you start to look at it, we're selling, on one side we're selling this, on the other side we're selling that, and we're using one FBA account, for example, for authority or whatever else. I think brands are really starting to focus on, okay, the longer term trend here is going to be continuing to move off platform and continuing to move to Shopify and those kind of places. Can we find businesses that are very well set up to do that, or have already taken steps to make that happen? So I think that, those are things to kind of keep in mind as people kind of go through longer term, just business strategic planning, if more than anything. And I think that, knowing your numbers is always, very important, in terms of, like I said, especially in e-commerce, I've never seen a set of financials that have been 100% accurate. And whether you need to hire an advisor to do that or, anything else, but I think that generally, it's easy to get dragged down by kind of macro sentiment at the moment. And I think that, and what we're seeing certainly is the market is very strong. We're busier than ever. Q4 just tends to be a very busy time of year in terms of deals getting, some of that's going to bleed into Q1 of next year too. But I think that from our perspective, we're at 150 people globally now across all functions. We're continuing to hire because we see the market, as robust and something that's going to see more demand come, in it as the kind of $1 billion, et cetera, IPOs start to fade and, deals start to fade away. There's going to be more deal making that's happening at this level of the market as well.
No, that's awesome. That's good to hear. A strong market, being a founder and operator, all the people listening, that's good to hear that there's demand. So it's exciting. So if for anyone that's listening, who is a good fit for FE International to help out?
Yeah. So like you said earlier, we deal with e-commerce, SaaS and content businesses. And the reason we deal with all three is that, oftentimes, founders, especially successful founders, may kind of go between different business models or try different things, over time. But I would say that for us, our deal size is usually somewhere between $1 to $100 million. And, we are looking for, or kind of we best serve, I should say, businesses that have, strong track records and a precedent of being able to deliver on continued growth year on year. Now, that said, most businesses that come to us will require a level of exit planning. So that's perfectly normal. I think the one thing that's kind of important to get across is that most businesses, go through at least 3 to 12 months of exit planning before going to market. So if you're thinking, okay, actually, next year, this time next year, I'm thinking of exiting, may not be right to have a conversation now. Like, you will never be wasting our time. We want to get in early because typically speaking, and this is a stat that we have, I haven't published this yet, but we definitely will in our next report. Businesses that go through at least, I would say, 6 to 12 months of exit planning tend to see multiples that are about 14% higher than businesses that don't. So the earlier we can get in and have those conversations with you, the better off you're going to be from probably a multiple perspective, but definitely deal structuring and other types of elements. So, anybody who's running an e-commerce, SaaS or content business that is on a, stable or growth trajectory with kind of, and a good level of profitability, it's going to depend business by business. So just have a conversation with us. It's always worth that because no two businesses look alike. And ultimately there's value, be that strategic or otherwise, in every business that we ultimately take to market.
That's awesome. Yeah. Makes a strong point too. That 14% is pretty cool. Awesome. So let's close out the show. We close out the show with a fire round. Are you ready?
Yes, I am. I remember this.
What is your favorite?
I came prepared this time. Favorite book currently is Checklist Manifesto. I'm probably going to butcher the name here, but it's Atul Gandhi. Yeah, Checklist Manifesto title. We've actually implemented that across our organization, and for anybody scaling, it's fantastic.
Awesome. What are your hobbies?
On a personal note, I've actually lost 81 pounds since the start of the pandemic. So I'm going to say gym is a hobby. That's incredibly boring, but that is the hobby of late.
That's awesome. Well, congrats. That's huge.
Thank you.
What is the one thing that you do not miss about working for the man?
Lack of meritocracy, I think, is the thing. I worked in banking, and that linear trajectory of no matter how good or bad you are, you're all on that path. It killed me. So I think that, being in a very meritocratic, organization now is the thing that kind of gets me up every day.
Perfect. What do you think that sets apart successful entrepreneurs from those who give up, fail, or never get started?
I think I would say shiny coin syndrome. I think that's the key thing. You need to be very focused on what you want to do. And this is advice somebody gave me a long time ago. It doesn't matter what you want to do in life or in general. If you plan to be number one at whatever it is that you want to do, the money will find you. So I think that's kind of, be very focused and very diligent on kind of one thing and then expand from a position of dominance as opposed to, splitting your time too thinly in the earlier stages. So I think, if you can avoid that kind of shiny coin syndrome, then I think you're much more likely to succeed.
Awesome. Excellent advice. So for all the listeners, how can they reach out and get a hold of you or your team if they're looking to get evaluation or exit planning help?
Yeah. So as I said, the team is much more useful than I am these days. I just tend to ramble. So I would just go to feinternational.com and there's a bunch of, forms and ways to get in touch there, or kind of Twitter as FEINTL. My business partner, Thomas, is always very active, on there as well. But the website has a bunch of resources and like a whole research section where you can find, reports about specific business models and other things. And always happy to have a conversation.
Awesome. Well, really appreciate you coming on the show, Ismael. And it's been over a year. And thanks for coming on. And maybe we'll have you on in another year to go over the next report.
Fantastic. Really appreciate it. Thank you.
Thank you, everyone, for tuning in to today's Firing the Man podcast. If you like this episode, head on over to firingtheman.com and check out our resource library for exclusive Firing the Man discounts on popular e-commerce subscription services. That is firingtheman.com/resource. You can also find a comprehensive library of over 50 books that Ken and I have read in the last few years that have made a meaningful impact on our business. For that, head on over to www.firingtheman.com/library. Lastly, check us out on social media at Firing the Man and on YouTube at Firing the Man for exclusive content. This is David Schomer.
And Ken Wilson.
We're out. Before you go, we wanted to share a new service that Ken and I have been using called Getita that has made us over $10,000 in Amazon reimbursements. The service requires no monthly subscription, and Getita collects a small percentage of the money they recover for you. It takes less than 5 minutes to set up and works on all Amazon marketplaces. Go to Getita.com, Getida.com, and enter promo code FTM400. That's FTM for Firing the Man 400 to get your first $400 in reimbursements commission free. How much money does Amazon owe you?